Hi guys, it's Doc Curry, and we have the last major market moving news for this year coming out this week. And whatever happens this week will probably determine where the market goes for the rest of the year and into next year. So let's get into it. Here's the major news that affected the cryptocurrency market this weekend. We're going to get into the stock market news and the economic reports that are going to affect the economy and the stock market over the next few months in just a minute. But first, let's talk about some major cryptocurrency news that came out over the weekend. Binance is the world's largest cryptocurrency exchange, and they're trying to calm investors, but its finances remain a mystery. Crypto.com, on the other hand, released its proof of funds over the weekend, showing that all customer crypto assets are fully backed one-to-one on the platform. Crypto.com actually showed that their reserve ratio is slightly higher than what customers are currently holding on the platform, meaning even if customers were to pull 100% of their money out of Crypto.com, Crypto.com does have the cryptocurrency on hand in order to fund all of those withdrawals. So this is great news for the cryptocurrency markets and should help restore some of the confidence that was lost during the FTX collapse. Or is it? Because there's one major problem with Crypto.com's proof of reserves. Crypto.com's audit was performed by Marzers Group, which is the former accountant for the Trump Organization. Keep in mind, the Trump Organization was found guilty of a tax fraud scheme. So the same auditing firm that audited the Trump Organization's taxes, which resulted in the Trump Organization attempting to get away with tax fraud, is now auditing Crypto.com's proof of funds. This is very, very sketchy. Of all of the auditing firms in the world, why did Crypto.com choose Trump's former accountant? This makes no sense, and it actually does not help improve things as far as customers feeling more secure about Crypto.com having funds on hand. And Binance has refused to show proof of funds. So some of the largest cryptocurrency exchanges in the world are not willing to show proof of funds in a credible way. And I would argue that this is not helping the situation at all. Here's what's happening with the economy and the stock market this week and into 2023. Now let's get into the stock market and the U.S. economy and some of the major market moving news that's coming out this week. A record 8.7% Social Security cost of living increase is starting in 2023. But this increase is kind of a double-edged sword. It's good for people on Social Security, but it's not so good for the economy with inflation. That's because this Social Security increase is going to have the same effect as wages going up, where this could help trigger this wage price spiral that the Fed is so concerned about. And as the Fed continues to raise interest rates in order to fight off inflation, this is hurting consumer finance companies. Consumer finance companies are offering fewer auto loans, mortgages, and buy now, pay later programs. The main reason is because these finance companies have lost access to easy money. And as less loans are given out for automobiles, less people buy cars. As less loans are given out for mortgages, less people buy houses. And as less loans are given out for buy now, pay later, less people buy durable goods. All of this combined means the spending is going to decrease, as in fact, it has already started to decrease in November. And this is the start of what could be a pretty significant recession here in the United States. If you were to base the recession upon a slowdown or decrease in consumer spending, then we could say that the recession would start in November of 2022 or last month. And speaking of mortgages declining, let's talk about what's going on with the housing market, because this is one of the major economic movers in the United States. Federal Reserve Chair Jerome Powell said that the boom phase of the housing market over the past few years was a bubble. And there's no doubt he's right, because housing prices went up by 45% over the past 2 years. So the question is, where are housing prices going from here? Next year's predictions for home prices are unusually varied. KPMG, an audit and consulting firm, is calling for prices to fall by 20% next year. Goldman Sachs forecast a 7.5% drop. The National Association of Realtors, meanwhile, is forecasting a 1.2% increase, and the Mortgage Bankers Association sees prices going up 0.7% in 2023. Now, what's interesting is that the auditing firm and the bank, which tend to be a little bit more third party and have a little bit more of an objective perspective, sees the housing market going down by between 20% and 7.5% next year. At least that's how much they think housing prices are going to fall. But the two organizations that are directly impacted by the housing market and have an interest in seeing the housing market go up are forecasting an increase of 0.7% and 1.2% next year. So again, when we listen to these forecasts, we have to take the forecast with a grain of salt and understand why these companies are making these forecasts. For the people that are forecasting a significant drop, what's in it for them? And for the people who are forecasting a slight increase, what's in it for them? I would say that for the people who are forecasting a significant drop, there's really no benefit to them saying that. I do believe they are giving an honest, open, objective opinion. However, for the people who are forecasting a slight increase, both of those two groups have a very vested interest in seeing the housing market go up. Those two groups being realtors and mortgage lenders, both of whom make money when people buy houses. So we wouldn't want those two groups to scare people into stop buying houses. No. Those two groups are going to directly contradict Jerome Powell and push people to buy houses, even though Jerome Powell said the housing market is in a bubble and you should wait to buy a home. And how long this slump in sales lasts depends in part upon how long it takes the Fed to get control of inflation. The Fed's efforts to slow the economy in great part depend upon the housing market slumping. Other factors, though, such as wage increases, could keep inflation rising. And despite the Fed's best efforts to slow down the economy in order to bring inflation down, so far their effects have been very limited. The labor market remains extremely strong, and even though the number of people buying homes has decreased, home prices still remain historically high. This is causing investors to grow more confident that the Fed will be able to pull off a soft landing. A few months ago, Wall Street rebuffed the idea that the Federal Reserve would be able to pull off a soft landing, but now a growing crowd is betting on exactly that happening. Mutual funds and hedge funds managing roughly $4.8 trillion in assets have been putting money into stocks that stand to benefit from inflation going down and interest rates going down and the U.S. economy avoiding a recession. These investors have a larger than average position in shares of industrial materials and energy companies. All three groups tend to be sensitive to changes in the economy, meaning investors' bets should eventually pay off if the U.S. can avoid a deep and prolonged recession, also known as a hard landing. The debate still rages on Wall Street, of course, and other investors say a deeper recession could be looming. There are additional challenges remaining, one of them being a red-hot labor market. Jerome Powell implied that wages are still growing too quickly to allow inflation to return to the central bank's 2% target. We've talked a lot on this channel about how the Federal Reserve is growing more and more concerned about a wage price spiral. That is, wages going up, which in turn causes more buying, which in turn causes higher inflation. That higher inflation causes people to want to go ask for raises, and those raises cause higher wages. Those higher wages lead to higher inflation, which leads to higher wages, which leads to higher inflation, which leads to higher wages, and on and on and on in what's known as a wage price spiral. If a wage price spiral becomes entrenched into the U.S. economy, then we will end up in a period of hyperinflation where the Federal Reserve will be unable to get inflation to stop, no matter how much they raise interest rates by. And if this corresponds with a recession, then that period is known as stagflation, when we have high inflation at the same time that the economy is becoming stagnant. This is a bad situation for the Federal Reserve, as it means they have to raise interest rates in order to push inflation down, which in turn causes any recession that we're currently in to be significantly worse. Both scenarios are really bad news for the Federal Reserve, the U.S. economy, and the stock market. And unfortunately, it looks like one of those scenarios is becoming more and more likely as wages continue to rise. We'll get more insight into this on Tuesday when the Labor Department releases its November reading for the Consumer Price Index. That report will offer the Fed's last look at inflation before it announces its final interest rate decision of the year on Wednesday. The CPI, or Consumer Price Index report, comes out on Tuesday at 8:30 a.m., or about 1 hour before the market opens. And the Federal Reserve will release its decision on how much they're going to raise interest rates by on Wednesday at 2 p.m., or about 2 hours before the market closes. The market is currently pricing in a 77% chance of a 50 basis point rate hike and a 23% chance of a 75 basis point rate hike. Now, even though the Federal Reserve is in a blackout period currently, which means they are not allowed to talk to the press, if the CPI report on Tuesday comes in higher than expected and the Federal Reserve decides to raise interest rates by 75 basis points instead of the expected 50 basis points, you can expect the Fed to leak this information out to the press. And usually that will come in the form of somebody on CNBC coming out and very adamantly knowing that the Fed is going to do a 75 basis point rate hike. So keep your eye on CNBC on Tuesday, especially, as well as Wednesday, to see if the Fed accidentally releases the fact that they are going to do a 75 basis point rate hike. Now, if the Fed does a 50 basis point rate hike, as they are expected to, we can expect the stock market to rally on Tuesday. But if the Fed does a 75 basis point rate hike, we can expect the stock market to sell off on Tuesday. Now, here's the other problem, though, that really throws a wrench into any expected movement on the Federal Reserve on Wednesday. This month's FOMC meeting also corresponds with a Statement of Economic Projections, or SOEP, release. The SOEP is going to let us know where the Fed expects to raise interest rates by over the next 3 months. And if the Fed shows that they expect to raise interest rates by more than expected over the next 3 months, this could also cause the stock market to go down. Further, if the Fed shows in their SOEP that they expect to hold interest rates at a high level for longer than expected, this could also cause the stock market to go down. And so far, Jerome Powell has been saying that that's what they're going to do, but so far, the market does not believe them. If, however, they come out in the SOEP and show that to in fact be the case, that could finally cause the stock market to wake up and start selling off again. So the problem is we could get a bit of a mixed result on Wednesday, where maybe the Federal Reserve does a 50 basis point rate hike, but then the SOEP shows that future interest rates are going to be higher and longer than expected. So we get the market up movement from the 50 basis point rate hike, but then we get a market down movement from the SOEP. Those two kind of even themselves out, and we don't get that big of a move on the Federal Reserve meeting on Wednesday. So I would not open up any kind of straddle, because the SOEP could completely reverse any movement from the rate hike. On the other hand, if the rate hike, say, comes in at 75 basis points and the SOEP comes in showing higher rates and for longer, now we get a double whammy to the downside, which could cause a significant sell-off in the markets on Wednesday, possibly by as much as 5% or more. And if you want to know how we're trading this and how we're going to make money off of this meeting on Wednesday, as well as the CPI report on Tuesday, make sure you join us in the coaching program, where we're going to be showing you our trades and showing you why we made those trades so that you can learn how to profit day and night as well. If you're interested in joining the program and learning how to trade options so that you can make money no matter whether the market goes up or down or even trades flat, then make sure you schedule a call with an onboarding specialist who can get you into the We Profit Day and Night coaching program so that you can start making money with us. You can schedule a call with an onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If this video helped you get prepared for the week ahead, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And be sure to hit the like button and subscribe. And if you want to know what stocks I've been buying as the market goes down, make sure you watch the last video that I uploaded here.